Welcome to the Bangers Only podcast, where Tom Lydon and his band of experts make money talk exciting. Here's your host, Tom Lydon.
Welcome to the Bangers Only podcast. Life is short. We need to keep things simple, folks. Use your time to focus on what's most important. That's what Bangers Only is all about. I'm Tom Lydon, your host, and today I'm honored to welcome Brian Portnoy, who's the founder and CEO of Shaping Wealth. Brian, my friend, welcome. Thanks for being here.
Great to see you, Tom. Thanks.
So, Brian, there's a lot of ways to describe what you do, but most importantly, you're working with advisors, institutions, individual investors, and coaching and training them on not just the importance of wealth management from a financial standpoint, but adding in that humanistic aspect to it as well. Am I getting that right?
Yeah. We focus on the human side of money. It's pretty easy to get drawn into the technical parts, the numerical parts, the spreadsheets. At the end of the day, money is probably the most emotional topic in our lives, but we lack the vocabulary to have great, meaningful conversations about that. And so, to some extent, I think what we do is that we train financial advisors and their clients to be fluent in the language of money.
Well, let me just throw this out to you as we're getting started. If you're a good asset manager and your numbers are good, your performance is good, shouldn't your clients be happy and shouldn't that be enough?
No, because the benchmark for most people, I would say round up to almost everyone, is not the S&P 500. It's not some market index. The benchmark that's actually most relevant to our lives is whether we have lived up to our values, lived through our values, that we've achieved some sense of contentment and purpose in this life. And we know, based not just on pontificating, but on rigorous behavioral science, that the search for more is ultimately quite unsatisfying. So you might have blown away the benchmark, this quarter or this year, and I guess that's a good thing. But that doesn't in any way necessarily translate into you having a good life outcome, which is what I think modern wealth management is about.
And when you say you've had a good life outcome, you're talking about the advisor, the asset manager, correct?
No, I'm talking about the client. I mean, I
Okay.
think yes, the financial advisors who we coach, advisors are people too. So, we're very interested in their well-being and their path to what I call funded contentment, the idea that true wealth is the ability to underwrite a meaningful life. So advisors, that is a very relevant concept. But my view of the modern wealth management industry is that we're helping people along life's journey so that they can lead lives of significance and meaning and purpose, and to some extent be happy. How can we help them arrange this one complicated emotional part of their lives, their money, their finances, in a way that supports that or underwrites that?
So when you look at the average asset manager or financial advisor who went to school, who studied markets, studied economies, studied valuations, became proficient in buying stocks or bonds or mutual funds or ETFs and actually got pretty good at it over time, do they have the tools to be able to help their clients in the areas that you're talking about?
Nope. I mean, well, the short answer is no. The longer answer is partially. We're talking about financial planning in order to drive great life outcomes. It's one of my core philosophies is that the portfolio should be in service to the plan, and the plan should be in service to your purpose. And so every step along the way there is important. And so with the portfolio and the elements of the portfolio, Tom, as you know, I was in the asset management industry for a long time, mostly in the hedge fund space. So, engaged with quite complicated investments. It's fascinating. It's interesting. There's the opportunity to demonstrate skill. And the question that we're answering in that segment is the what, the portfolio and the pieces that make up the portfolio. But then the plan, well, where are we going with all of this? That's the how. And then the purpose that drives the plan, that drives the portfolio, that's the why. All three questions are relevant, but we don't ask them all at the same time. And we don't have those conversations with the same people: the why, the how, and the what.
So, talk about the state of the investment advisory business, for example. We'll just carve out that segment.
Mhm.
Um, are they focusing on the plan and the outcome and the satisfaction and that feeling, the emotional part that clients are looking for, when in fact they're struggling with day-to-day markets and
Mhm.
volatility and fluctuation? How does the firm make that transition, or at least include that into their general offering?
Yeah, so I'd make a pretty stark distinction between investment management and wealth management. I'm
Okay.
not sure how much investment managers need to be concerned about these topics. They have client assets, they're managing those assets according to a mandate, and they're trying to do a good job, however that's measured, usually relative to some sort of benchmark. It is important to think through, well, what is the experience that you are providing to those investors in terms of the volatility, what does it mean to succeed or win through that portfolio? So those are, I think, important considerations. But on the other side of the bright line is the wealth management industry. That's where financial planning takes place. And that's where I think we should be less focused on the investment outcomes and more focused on the types of considerations that I've been writing about for a very long time, that we've built this firm around, and ultimately, us trying to inspire better conversations between financial advisors and their clients about the life they want to live and how they can afford those lives. The investment manager is part of the solution that the financial advisor brings to bear.
So when you think about family offices, for example,
Mhm.
you're gearing up towards, yes, you're managing the portfolio, but there's so many aspects to managing the wealth, but also understanding the family, being
Yes.
there at tough times, being there at enjoyable times, as opposed to the average RIA that might have 100 to 150 relationships. They're probably not going to be able to have the time or the skill set or even the staff to be able to do some of the things you're talking about, right?
I think I'd probably position it a little bit differently. I mean, starting with the advisor, the RIA that's taking care of 100 families, depending on not just their resources, but their mindset, they absolutely can have the types of important conversations that we're taking, that we're talking about. So, if you're one person managing 300 family accounts, well, that's sort of an odd business to begin with. Your typical RIA has plenty of time and resources to help clients achieve funded contentment. On the family office side, you're absolutely right, Tom. I mean, those are complicated dynamics. I think it's fair to say more money, more problems. So the idea that you've gone from 10 million to 100 million to a billion in assets, wherever a family is, um, humans are still human. The emotions that we feel about money and everything else don't change, but the complexity in our lives kind of increases astronomically. And therefore, people who work in a family office, the investment and wealth talent that serves the family, they have to be relatively savvy in financial dynamics. I mean, we could joke, but it's funny, not funny. Shows like Succession, where you see, people who have dynastic wealth. Their great great grandkids will not run out of money. There's no way that that could happen, and they're quite miserable. So, how do outsiders of one kind or another intervene to develop an understanding, structure conversations so that people can be relatively happy with whatever money they
So I'm being a little bit tongue in cheek here with my cold heart approach.
have?
You
Okay.
and I have been friends for a long period of time. We know each other.
Mhm.
We value our relationships tremendously, and most importantly, I think in the advisor business or the wealth management business, the number one thing is trust.
Mm.
And through this, and through some of the things you're talking about, that's how trust is built, right?
Yeah, I mean, I'm glad you brought it up. I mean, I should have brought up the word about 5 times already. Trust is the ultimate social currency. Trust is what allows us to survive and thrive. Survive and thrive tens of thousands of years ago when civilization was tiny. Survive and thrive now with 8 billion people on the planet and the never ending noise of the internet and social media and AI and everything else. At the end of the day, Tom, like we are born as social creatures. We are born as tribal. I mean, we obviously think about ourselves as individuals who cherish freedom, liberty, opportunity. Of course we do, and that's absolutely important. At the same time that we cherish our independence, we cherish our connection to the group. And so we are hardwired from a neurological point of view to value that sense of belonging. And we know instantaneously when that sense of connection or belonging is diminished or cut, when trust disappears. We're very, very sensitive to that. So, in our world of money management, wealth management, where you can build and maintain and scale trust, you're doing really good work.
Yeah, yeah, great. Okay. So I know in your book, How I Invest My Money, you
Mhm.
asked a lot of pros to share how they actually handled their own finances,
Right.
and you were surprised of their answers. Maybe share a little of that.
Yeah, that was an amazing project. So, my co-editor, Josh Brown, who everybody knows, wrote an amazing blog called "How I Invest My Money," and we took that idea and then asked a bunch of friends to write their own 5-page story about how they manage their own money. And what was really cool about that project, and by the way, Volume 2 is coming out next year. What was really cool was to see across 25 different experts in money tell 25 completely different stories as to how they manage their money, how they think about saving, spending, investing, charitable giving, managing risk. And it kind of comes back to where we started the conversation, which is that everybody is trying to live up to and through their values. They're trying to achieve some form of significance or meaning or purpose in their lives. And the fact that you could be an active stock picker or that you could just benchmark to a market index, whatever your choice along that spectrum, that's a means to an end. And so, even though the book's called How I Invest My Money, what came back to me across 25 chapters is that even though we didn't ask it this way, people answered the question, why do I invest my money? What's important to me? How do I, and I also mentioned this earlier, how is the portfolio acting in service to the plan?
So what were some of the biggest surprises that you saw from people that you know, and it was a head scratcher when they shared how they managed their money?
Oh boy, you're gonna actually make me tap into my memory, Tom. Good thing.
Well,
Um,
let me just say this. I know from being an advisor for a long period of time, and it's kind of like doctors. You take care of everybody else first, and you're the final patient that gets attention. And I know that that runs rampant in the asset management business. Can you concur?
oh, for sure. In some ways, it's easier to take care of others than yourselves. One of the things that I loved about this industry for more than a quarter century now is that it's filled with servant leaders. It's filled with people who do care about others, notwithstanding, I think, some pretty negative press that elements of our industry get. Yeah, it's we are mostly dominated by servant leaders who want to do right by others. And one thing that happens with servant leaders is that they don't take care of themselves. So, to your earlier question, we just saw in the entries to that book, people take on all number of different investment styles. Some basically showing through what they wrote that they don't even care about their investments, that they own the market writ large and that they're focused on their grandkids or a summer cottage. You've got others, I would say a third to a half of the contributors to that chapter paid off their mortgage early, even though sort of financial orthodoxy says that, well, you shouldn't do that because you could invest in the market at a higher rate. And so you saw one expert after another basically make it up as they go along and not really follow the guidebook or the textbook, even though half the people in that volume wrote the textbook. That's just not the way it goes. I mean, the real quick anecdote that I love wasn't in the book, but it's a great anecdote is that Harry Markowitz, who invented sort of modern portfolio theory and obviously knew the nuances of the way you're supposed to do these things, was asked once, and this is decades ago, hey, how do you invest your money? And his answer was, I put about 50% in stocks, 50% in bonds, feels about right, and then I get on with my life. This was the guy who invented it all. So I think that's a good window into the mindset of how experts manage their own money.
So you've argued that figuring out what's enough is one of the hardest questions in life. How do people know when they found that right version of enough for themselves?
It starts with recognizing that more is a number, but enough is a story. And that when we come to terms with the story that's meaningful to us, to keep in mind, Tom, that we are as a species not particularly numerate. Even though our industry is filled with numbers and spreadsheets and such, we're not good at math. What we are good at, what we're hardwired for, is story. The neuroscience of story is actually quite profound, and it shows that we live our lives through the lens of narrative, that we're all on our own version of the hero's journey, sort of, killing the dragon and searching for the treasure and so forth. When it comes to defining enough, therefore, what we're doing on a regular basis is basically telling and retelling that story to ourselves and to our loved ones about what makes sense. Where are you going? What is that path? And when people have the sense that they have enough, it's because the story that they're telling to themselves, it makes sense, that it feels right. It's never a number. The data is overwhelming. People who have $1 million say that they'll be happy when they have two. People who have $2 million say they'll be happy when they have four. It's the stone of Sisyphus. You get to the top of the mountain and the rock rolls all the way back down. And we spend our lives going up and down, up and down. That's one element of this. When we have our stories straight, when we're comfortable basically with who we are and where we're going, the money just fits. Most of us aren't there, though.
It's hard. And
Really hard.
dealing with my peers, I find that some who have retired, close to retirement, thinking about retirement, uh, that's a whole other aspect of it, especially if you've been in wealth management or asset management business, because
Mhm.
they're great people, friends like us,
Yeah.
where I can't imagine spending all that time on the golf course or on the pickleball court or doing the New York Times crossword puzzle. Part of it defines people in the asset management business, and it's hard to step away.
It is. It is. This is why, and let me revisit this notion of funded contentment. I coined this term in the geometry of wealth 7, 8 years ago. And what I'm really proud of, one of the things I'm proud of in my career, is that concept seems to have landed well with friends and neighbors and strangers all over the world. Because the idea here is that rich is that search for more. We've talked about it, and it's ultimately quite unsatisfying. But true wealth is this ability to underwrite a life that's meaningful to you. Happiness on a day to day basis comes and goes. You wake up, you're in a good mood. Some days you're in a bad mood. That's not what we're talking about. We're talking about that deep sense of contentment, that your life is what you want it to be. What I've been advocating as author, business builder, advisor, coach, is that the process is two steps, and it starts where you don't think that it might. It starts with asking first, what's meaningful to you? What are the sources of contentment that define your life? Whether it's your connection to your community, or your sense of autonomy, or the joy that you get from your work, or your connection to the broader cosmos through your faith or your patriotism. There's lots of sources of contentment out there. We go through that exploration first, which, by the way, is not the normal place for finance experts to be, but that is where it starts. And then we only ask second, can I afford those things? How do I underwrite those things? What does my money life need to look like so that I can have those sources of contentment over time? This
Yeah.
is kind of a different way of approaching things, but I'm biased. I think it's the right way.
Okay, let's talk about the kids. We've all heard the stories about, the Vanderbilts, who richest family in America, and
Mhm.
within 3 generations they piss the money away.
Yeah.
That story happens every day in America, and there are a lot of folks that have worked really hard to accumulate wealth, invest the right way, and then by the time they check out, they pass it on to the next generation, and they're not equipped to be able to handle all the pressure that money brings. What are some things that we need to do to teach our kids to understand the responsibilities, let's say?
Well, I mean, we start with number one, this, I think, very important idea that more doesn't solve problems. And in some cases, more creates problems. We also start with the idea that sort of wealth, true wealth, is attached to our identity and values before it's attached to our balance sheet or our portfolio statement. And that, you gave the example of the Vanderbilts, but yeah, we all know, wealthy families. What is it? Shirt sleeves, the shirt sleeves in three generations. However that saying goes, you know, it's not because there wasn't enough money. It's mostly because there's not enough self-awareness in a particular individual, and there's not enough values alignment in a family context where the money, I won't say wealth, where the dollars and cents are being put to good use. And I don't mean good use in, oh, you have to give it all to charity. I'm saying that the money is being spent and saved and borrowed and invested in ways that align with your values. So, for better for worse, and it's not always a comfortable place, having these conversations about money with different people, whether it be an outside coach or expert or family counselor, whether it be with your partner, but most importantly, a conversation with yourself. This is how, when we think about generational wealth, it's built on those conversations. It's not built on a fine-tuned investment in particular alternatives or real estate or whatever.
Brian, I talk to myself all the time, and sometimes I try not to listen. But you're right. Is from a communication standpoint, bringing the next generation in at a young age
Right.
is, I think, important. A lot of times, couples who are successful tend not to want to burden the kids with the subject of money and the
Mhm.
negative things that money can bring. Why is it important to bring them in early? Because again, going through some stuff myself, I want my kids to be able to run their life the way they want to run it, and stub their toe along the way, bloody their nose along the way, have some successes and failures. That's how you lose, and I'm sorry, that's how you learn and you build up that scar tissue along the way. Once you introduce this other responsibility, does it change things, or is it something that's really important to do as far as a family's concerned?
It's a leading question. It's very important to do. Absolutely. The question is, why don't we do it most of the time? So, the American Psychological Association every year issues a large report on stress in America. And almost every year, the number one source of stress in people's lives is money. And the number one topic that people don't want to discuss is money more than politics or religion or even mortality. We'd rather talk about our death than our balance sheet. Okay. Now, why is that? Well, from a neuroscientific and a psychological point of view, it is tapping into our deepest survival instincts. And humans are so finely tuned to care about their own survival. So we don't go there. This requires a certain amount of bravery on behalf of parents, grandparents, uncles, and aunts to include the younger generation in age appropriate conversations about money. And some elements of that is going to be mechanical. I mean, we'll date ourselves by referring to something called a checkbook. I don't think my kids know what a checkbook is. But, what is a checkbook? And these days, how do you use these financial apps that are on their phones, and what are the pitfalls? What are the opportunities there? So there's the mechanical pieces to financial literacy that are critically important. But if we teach the mechanics without the human side of advice, then we don't have that grounding in the values and identity that I've been kind of harping on, off and on through this conversation. So thinking about, well, what's really important to you, and where does money fit into that? Those aren't always easy conversations between parent and child, but the more that we can structure those over time, I think it's almost a lock that your kid is going to have a much more open and robust sense of how to navigate all of the money complexity, which is at an all-time high
Yeah.
between 24/7 global capital markets, apps where you can trade 24/7, what we see on, sort of places like TikTok. There's a lot of noise that can corrupt the mind. And the more that we can get in front of our kids early and talk about these things in a calm and balanced way, I think they're going to be much better off.
I like the way you described it, the mechanics, because that's really what it's all about. It's an ecosystem, and kids are smart. Kids are tech savvy. They can figure all this stuff out. It's also funny, if I can share. Last week, we were with three other couples, and we're sitting around the dinner table, and we got on the subject of, I'm going to call it the card. And this is the universal credit card that's used within the family. And over time, as your kids become more mature, you want to cut the strings to the card. And we had the funniest story, because every family found themselves in this situation, whether it's you're paying for their phones, or they get to order stuff on Amazon, or it's Netflix. And every family in their own way is trying to, like, cut the cord a little bit too. It's funny because every family goes through this stuff. And talk about heartstrings. Like,
Yeah.
my baby daughter, she just gets married. I'm in the process of, like, cutting the cord. And my wife's like, have you pulled the card yet? I'm like, I'm having trouble doing it. Right. So it's
Right.
just, it's one of these things, but it's important. It's important to talk about it, not just, father, daughter, but as a group too, because there's a life lesson to be learned.
Well, your story is making me chuckle. What I won't go into depth on, because I'll become infuriated, is the topic of DoorDash. For some reason, my three kids, all away at college, seem to think that DoorDash is their birthright, and it comes through dad's credit card. And those delivery fees are quite significant.
Yeah.
Yeah. So
And
look,
you're a good cook, right? So why don't they
well,
use your mastery in
they're
the
they're
kitchen?
they're they're far away. Um, they're not coming home for cooking, but they can get off of the couch and go pick something up or make it themselves, or go to the dorm that we pay for, where there's a very nice cafeteria, right? So, joking aside, we want to be generous. We want to support the people that we love, but sometimes the paradox is that the more we show that support, the more we disable them to be really savvy on these sorts of topics into the future. And so cutting that cord, cutting that card, as you've put it, it's sometimes you just got to let them go. By the way, I'm not very good at this either.
Brian, this has been great. Listen, if somebody wanted to get in touch with you, how would they find you?
Yeah, so my company is Shaping Wealth. We coach financial advisors and their clients around the world on this topic of funded contentment and financial well-being. So shapingwealth.com is our website, and that's probably the easiest way to get to me, as well as LinkedIn. Sort of on LinkedIn, like everybody.
Yeah.
Easy to find me there. Easy to just sort of shoot me a message, and I'll be happy to get back to you.
Yeah, reach out to Brian if anything applies to you and your business. Brian, I can't thank you enough. This is great. You've given me that encouragement. I'm getting the scissors out.
Go for it, man. Just cut the card.
Thank you.
Thanks.
The opinions expressed in this podcast are for informational purposes only and are not intended to provide specific investment advice. Any past performance discussed during this program is no guarantee of future results.